Welcome to SNK and Company. In this session, we bring you a deep dive analysis of the Draft Income Tax Rules 2026 and their comparison with the Legacy Income Tax Rules 1962. This reform marks one of the most comprehensive rewrites of India's direct tax compliance framework in over 6 decades and is closely aligned with the new Income Tax Act 2025, which comes into force from April 1, 2026. At a structural level, the government's objective is very clear: simplification, digitization, inflation alignment, and litigation reduction. Many limits under the 1962 rules had remained frozen for decades, despite significant changes in salary structures, urban costs, and employee compensation models. The 2026 rules attempt to correct this historic misalignment. Let us first understand the macro philosophy shift. The old income tax rules, 1962, were built for a paper-driven economy with relatively simple salary components. Over time, patchwork amendments made the framework bulky and difficult to interpret. The new rules attempt consolidation, modern drafting, and technology alignment. From SNK and Company's perspective, this is not merely a revision, it is a generational compliance reset. Now let us move to the most impactful area: salary and perquisite taxation. One of the biggest changes under the draft rules is the inflation-linked revision of exempt allowances. For decades, limits such as children education allowance, hostel allowance, meal benefits, and gift exemptions had become economically irrelevant. The 2026 rules significantly enhance these thresholds to reflect present-day costs. For instance, the free meal exemption has been proposed to increase from 50 Indian rupees per meal to 200 Indian rupees per meal, which can translate into an annual tax-free benefit of about 1.05 Indian rupees lakh, where 2 meals per working day are provided. From a compensation structuring standpoint, this is a major positive for salaried employees and HR planners. Similarly, children education allowance and hostel allowance limits have been sharply enhanced, which could materially reduce taxable salary under the old regime and make it more competitive again. At SNK and Company, we believe this is a deliberate policy move to rebalance the attractiveness between the old and new tax regimes. However, not all changes are beneficial. The valuation of company car perquisites has been revised upward to reflect current market realities. This means senior executives enjoying employer-provided vehicles may see higher taxable perquisite values and consequently higher TDS outgo. Employers will need to revisit CTC modeling and payroll tax provisioning. Now let us discuss one of the headline reforms: HRA rationalization. Under the 1962 framework, only 4 metro cities, Delhi, Mumbai, Kolkata, and Chennai, qualified for the higher 50% salary benchmark for HRA exemption. The draft 2026 rules propose expanding this list to include Bengaluru, Hyderabad, Pune, and Ahmedabad. This is a very significant relief measure. Employees in these high-rent urban centers will now be eligible for higher HRA exemption, thereby reducing taxable income. The move recognizes the economic reality that rental costs in these cities are comparable to traditional metros. From a planning perspective, salaried taxpayers in these cities must recompute their HRA optimization strategy once the rules are finalized. Let us now turn to PAN rationalization, another major compliance shift. The draft rules propose substantial changes in PAN quoting thresholds across multiple transactions. For example, PAN will now be required for motor vehicle purchases only where the value exceeds 5 Indian rupees lakh, whereas earlier it was mandatory irrespective of value. Property transaction threshold for mandatory PAN quoting is proposed to increase from 10 Indian rupees lakh to 20 Indian rupees lakh. Hotel and event payments threshold is proposed to rise from 50,000 Indian rupees to 1 Indian rupee lakh. This is a calibrated compliance easing for small and routine transactions while continuing strict monitoring of high-value activity. Simultaneously, PAN will become mandatory in more structured financial relationships to enhance traceability and transparency. From a risk management standpoint, the tax department is clearly moving toward targeted surveillance rather than blanket documentation. Another important modernization is the recognition of digital money and tighter reporting ecosystem. The draft rules formally recognize central bank digital currency, the e-rupee, as a valid electronic payment mode and also propose enhanced reporting obligations for crypto intermediaries. This signals the administration's clear intent to future-proof the tax system for the digital economy. Now let us evaluate the old versus new tax regime dynamics. For the last few years, the new tax regime had gained popularity due to lower rates and simplified structure. However, with the sharp increase in exemption limits under the draft rules, the old regime may once again become attractive for taxpayers with structured salary components and multiple allowances. Experts estimate that a taxpayer earning around 15 Indian rupees lakh could potentially save substantial tax under the revised exemption framework. This creates a strategic decision point for taxpayers. The choice between old and new regime will now become more case-specific rather than one-directional. At SNK and Company, we strongly recommend personalized tax simulations before regime selection for FY 2026 to 27 onwards. Another subtle but important shift is the movement toward digital books and system-driven compliance. The draft framework increasingly emphasizes electronic records, automated reporting, and data integration. This aligns with the broader faceless assessment and AIS-driven verification ecosystem under the new income tax architecture. From the tax administration's perspective, the message is clear. Compliance will become easier procedurally but stricter analytically. Mismatch-based scrutiny is likely to increase. Let us now discuss the practical impact across stakeholder groups. For salaried employees, the rules bring both opportunities and cautions. Higher exemptions for meals, education, hostel, and HRA can significantly improve take-home pay. However, higher valuation of certain perquisites like company cars may offset some benefits for senior employees. For employers, payroll systems, salary structuring, and perquisite valuation policies will require immediate review. HR and finance teams must prepare for reconfiguration well before April 2026. For tax professionals and advisors, the entire rule numbering and compliance mapping will change. There will be a transitional learning curve, but over time, the simplified structure should reduce interpretational disputes. For the government, this reform supports the broader goals of voluntary compliance, litigation reduction, and digital tax administration. In conclusion, the draft income tax rules 2026 represent one of the most consequential compliance modernizations since the original 1962 framework. The reforms are clearly pro-simplification and partially pro-taxpayer, but they also strengthen the data-driven enforcement architecture. At SNK and Company, our considered professional view is that taxpayers should not assume automatic tax savings. The real benefit will depend on salary structure, city of residence, perquisite mix, and regime selection strategy. The next 6 to 9 months will be crucial as final rules, utilities, and payroll guidance are notified. Businesses and individuals who prepare early will be best positioned to optimize tax efficiency under the new regime. We will continue to bring you clause-by-clause deep dives as the final rules are notified. Thank you for watching SNK and Company. Stay connected for advanced professional tax insights.